Was Powell's speech, Joe, a game changer or not?
Definitely a game changer. We had the yield curve steepen briefly. We had gold prices rally. The dollar soften. And as you know, equities up massively. The market is right, Sarah. The economists, as per usual, are wrong. This was a game changer.
Are you a buyer on this news, Alli?
You know, the way that we're approaching this at UBS is, there are a lot of, you just talked about, for example, the meeting that's going to happen later this month. We're looking at what's going to happen as a result of the Argentina meeting. I think that the answer is, if we're putting money to work right now, we're putting it to work either in a structured way in the U.S., specifically towards value and within value financials and energy, or we're putting it in just pure optionality firm. Because right now, we're not a buyer of anything. I think, as you said, there are a couple events that are going to be very binary in the next month. And people are looking, whether it's 2 rate hikes or 4 rate hikes, that's meaningful. And the way that the market has been reacting in the last 9 months, I would say since February, to news is the market is reacting to sort of news on the margin, and the market is reacting to really meaningful news. And so I think we have to be careful. We are overweight global equities. Most of that is in the U.S., but we want to do it in a way where you can manage your downside risk as well right now.
Joe, how specifically are economists wrong right now? I mean, wrong about 2019, for example, and how does it differ with what the Fed is looking at? A slowdown in growth from this year, maybe somewhere close to the targets on inflation and employment. The data that the Fed looks at still looks like a neutral rate is probably what they need to try to get to.
So, Michael, well, first of all, the profession has been consistently over-predicting, as monetary policymakers, the path of rates. And they've also consistently, as a group, overestimated inflation. Inflation is likely to move lower. Growth will remain solid. There's no link that growth causes inflation or that tight labor markets cause inflation. That whole thesis has to be revised. The neutral rate is an absurd concept. It's a unicorn rate. It doesn't exist. The housing market is telling us right now, as I've argued for some time, we're already past neutral. So the Fed needs to really recalibrate its thought process. What it watches, it needs to stop raising rates, let the balance sheet unwind, and let there be some price discovery in financial markets to the extent that's possible.
Yeah, I mean, maybe just get rid of the word neutral. It's causing so much angst. Nobody knows what it means. Nobody knows whether we're close or under. Alli, what about the other market moves? I mean, oil's up right now, but earlier it fell below $50, first time in a year. The 10-year Treasury note yield fell below 3%. What are the cross-asset correlations telling you as it relates to stocks?
No, that's a great question. And actually, the really good news is that we are finally seeing some movement up in one market while we're seeing some movement down in the other markets. And that's what we look for when we think about how to invest and how to diversify. So as opposed to the last couple of months where you've seen the bond market moving down at the same time that the equity market seems to be correcting, we're happy to see that what happened yesterday, for example, that you're seeing bond yields come down as people feel comfortable moving back into risk assets. I think oil is a really interesting temporary phenomenon right now. We at UBS see a sort of 6-month and 12-month horizon at about $85. We think a lot of the things that are happening, whether it's Iran, Saudi Arabia, Russia production, are really sort of very specific things happening now that are restricting supply in an artificial way that we are going to move beyond. So again, when we're putting risk on the table right now in the global equity
So you like
market,
energy stocks on that
call?
We
love energy stocks. I cannot fundamentally understand why financials aren't behaving better. And when you look at what happens late cycle, you really look for a value rotation instead of growth. And when you look at value indices, they are largely made up of financials, and they're largely made up of oil. The other thing you have when you go into those two markets that is really interesting and meaningful now those are probably the two markets that in theory are least susceptible to trade rhetoric and to the actual implications of what happens. And so I would expect that as we see movement from the G20 or not conversations this week, as we go into January, and do we go into like phase 2B in terms of raising the level of tariffs to 25%, that those are the markets where we're going to see outperformance.
How does the credit situation filter in? I mean, if you're looking across asset classes, we had a little bit of a mini panic in corporate credit. Maybe that's why financials haven't acted that well.
That's very fair. And we, Jay Powell's comments yesterday really highlighted exactly what we've been looking at, which is, since 2009, since the end of the crisis, leverage on balance sheets has gone up twofold. There is a lot of refinancing that has to go on. Most of that is in an area of the corporate credit structure where we are a little concerned. So that is absolutely something we have to take a look at. But I think the good news from the financial perspective is those banks are going to be involved in all those refinances. We're already seeing the cost of leverage, whether you're talking about the average mortgage rate and what that's doing to the housing cycle. We're seeing all that play in. And M&A activity, as we see every day on this show, is going crazy.
So finally, Joe, looking forward to the G20 meeting this weekend. I mean, it sounds like you're pretty optimistic about where we see the economy, and you're happy about Powell. And I'm just wondering how much you think that the trade friction with China is impacting the overall economy, and what's at stake this weekend? Well,
I think yesterday showed that this whole year has been about Fed policy. And the trade stuff, while not irrelevant, certainly it's important, but is basically a sideshow to what monetary policy has been doing. So to me, when looking at G20, the bar is set very low in terms of what productively may come out of that. So we might actually go into the next month with a risk-on mentality, given the fact that maybe anything that comes out of G20 is mildly positive. My guess is that a lot of the bad news in markets has been priced in, from oil to risk elsewhere, EM even, especially if the dollar weakens, that's going to help EM.